Finally, we're moving on to the industrial market. Again, we'll have the overview, the current status, the trends, and the tenant perspective. But just touching on the overview, the Australian industrial market is undergoing a shift with vacancy rates increasing, offering a welcome reprieve for tenants who have struggled with historically tight conditions. This rise in vacancy provides more leasing options and potentially greater negotiating power for occupiers. In New Zealand, these rates have remained relatively the same. However, we expect New Zealand to follow Australia and see an uptick in vacancy over this year. The boom in e-commerce driven demand for industrial tenancies appears to be slowing down, contributing to market stabilization. Various research shows rising vacancy rates and stagnant rents. In Sydney, industrial vacancy rates have increased to nearly 4% after hitting record lows in 2023. Across Australia's east coast, vacancy rates have also risen, now stabilising around 3.5%. Effective rents are under pressure due to high tenant incentives, which have doubled in some areas over the past year. However, despite these trends, tenants are still facing supply constraints. Whilst tenants may benefit from slightly more choice and greater incentives, the overall cost of securing space remains high due to continued demand and limited new developments. Thanks, Ken.
Thanks, Ed. As you touched on, the e-commerce has placed a considerable amount of pressure on the industrial space. And with the slowdown, this has been one of the major drivers for the warehouse demand over the last kind of 2 to 3 years. As a result, it's put pressure on vacancy rates, which have increased and reduced effective rentals, with the vacancy rates increasing for the first time in over 2 years. The rapid growth in demand for industrial space seems to have slowed down as the market adjusts, which indicates there is a correction happening in the marketplace at the moment. As Ed mentioned, vacancy rates in all major Australian cities have risen, but Australia still has some of the lowest vacancy rates globally. Without a significant influx of uncommitted stock, vacancy rates are expected to remain at these levels for the next 12 months. As the demand softens, there is pressure on landlords to reduce face rents, but at the same time offering higher incentives. In sub-markets, we've seen incentives increase to as high as 20%, which is a sharp contrast to a lack of incentives just seen over a year ago. What are the market trends? As we have alluded to, there is a market correction that is taking place in the industrial sector at the moment. Along with the slowdown, we are witnessing rents decreasing in some markets by as much as 5 to 10%. This is more relevant in stock which is owned by private investors. On the other hand, owners, particularly institutional owners, are still keen to maintain their face rents to uphold balance sheet credibility, which has in turn placed pressure on incentive levels. In some markets, landlords are pushing for rents as high as $500 per square metre, and this in turn are forcing those tenants to consider other industrial markets and even other capital cities. Due to a rise in construction costs and the slowdown demand, developers are now adopting a more cautious approach rather than speculatively building a site, and now they are seeking pre-commitments for tenants before they are proceeding with new builds. Whilst the days of double-digit rental growth are now behind us, landlords are exploring various types of industrial properties, all those with more value-add opportunities. So where do the opportunities lie? The industrial market has been a landlord's market for the past decade. While the market is adjusting to lower demand and some better levels of supply, there is still little leverage for tenants, both in terms of market conditions and lease conditions. And the sustained growth of the market has skewed typically towards the landlord. In order to shift the needle on the barometer back to the tenant, careful consideration of business needs, expert knowledge of marketplace experience, and patience are essential. On the next slide, we'll look at a couple of different strategies that we can assist in order to move the barometer to a more balanced, tenant-friendly situation. As we've alluded to, there is some good news this quarter for tenants. However, there are several strategies that we have used to improve an industrial tenant's position. Our negotiation strategies turn on the 5 key categories of cost, risk, flexibility, obligations, and guarantees. Whilst there should always be attention given to costs in a market such as the current industrial market, driving down costs is not impossible. But it's always a difficult proposition. It's always arguably the better outcome may be achieved by focusing on other factors. Given the market correction, this could be an ideal time for tenants to consider an early lease restructure by restructuring the lease before expiry. By initiating these discussions now, tenants may be able to secure more favourable terms that reflect both current and future market conditions. This could include bringing forward a market incentive, negotiating capital for some improvements to the premises, and securing a renewal extension that better aligns with the business objectives and goals. Another strategy available is to look at mitigating risk and transferring certain obligations to the landlord via side deeds through a variation of an existing lease. Everything is negotiable, but make no mistake, it is hard yards and it does take skills and patience to negotiate these terms.